Hello, I'm Leila. I'm a Chinese woman working as a financial advisor for Chinese ultra-wealthy families in Beijing. My daily job involves analyzing Chinese macro environment. I will visit some investment target companies like the robot companies, flying cars companies, semiconductor companies in order to provide a comprehensive asset allocation plan for my clients. So I believe I'm quite familiar and professional in topics related to Chinese economy, investment, technologies. These are literally my everyday conversation with my clients. Today I want to show you something most people never learn, that how currencies really works and why the Chinese yuan and the RMB stay quite stable during the past years. Even though that you are not a client of mine, I believe it is a very good content that you can compare with short videos or textbook. So please keep watching. This is a great story. Let's go. We have noticed that during the past few years, a lot of currencies were on a roller coaster. The most dramatic case is the Turkish Lira, which has lost about 95 of its value since the year 2014. The Japanese yuan, Korean won also weakened. Even euro, it is go up, go down constantly, especially when they compare with Chinese yuan. The RMB is actually surprisingly stable. Why? You may think I'm going to talk about Chinese massive economy. I want to show something deeper, something that many Chinese citizens rarely recognize, that China actually has a very unique currency issuance system. First, we probably need to answer a very simple question, that is, why do countries borrow money? If printing money is so easy, why not just to print more? The truth is that money printed by a central bank is not real capital. Printed money creates liquidity, but it does not create resources. It cannot print steel, oil, or machines required to build airports, railway, or semiconductor companies, right? To obtain real resources, nations must buy them from abroad. Foreign suppliers do not accept the freshly printed local currency. They want something strong, internationally recognized money, usually the US dollar. So when countries want to develop, build infrastructure, expand manufacturing, secure energy, they have to borrow foreign currency. This is why especially borrowing US dollars became the standard path for many developing economies. The large external debt can be very dangerous for a country's currency. It is often called the
US dollar tide.
Here's a simple logic behind it. When a country borrows a large amount of dollar-denominated debt, and if the Federal Reserve, which is the central bank of the US, raises the interest rate, the dollar will strengthen, and suddenly the capital will flow out from the country to the US, and the local currency will depreciate, making debt repayment much more expensive. In order to stop the outflow, the country must raise its own interest rate, but higher interest rate is not good for local business. It will reduce consumer spending and slow down the entire economy. At the same time, because of the currency weakens, the importation price will rise, hence accelerates the inflation. And the country will enter into a very painful cycle, that is the devaluation, interest rate hikes, inflation, more devaluation. But China chose a complete different path. China simply does not rely on massive amount of US dollar debt. Its external debt pressure is extremely low, that people will ask, really, that China does not borrow foreign debt. How did China just print money to grow? Of course not. Money can't be printed as you wish. We already talked about it, right? Here comes Chinese surprising way of creating money. So it relies on a domestic credit expansion model, primarily through real estate. You definitely heard about the China's insanely high housing prices in Beijing. A modest two-bedroom can cost 7 to 8 million RMB. That is too expensive for everyday living for sure. But here is a twist. The higher the housing price, the more money circulates in the market. Real estate is actually the secret engine injecting money into Chinese economy. This is a two-step system. The step one is earning foreign currencies. China accumulated its first pot of gold by becoming the world's factory, right? We export appliances, electronics, machinery, clothing, and earn dollars. Imagine I'm a small toy factory owner. I sell toys and I earn 1 million US dollar. I take it back to my local commercial bank like the ICBC. I exchange it into RMB. The bank will sell my US dollar to the central bank, which pays all the RMB and is the US dollar to Chinese foreign reserve. I used the converted RMB, the Chinese yuan, to expand manufacturing and give bonus to an employee, Xiao Wang. Yeah, came from a small town in China. This is the second step. Domestic credit expansion, the China's true engine, urbanization. The hundreds of millions of people, they are just like this Xiao Wang. They moved to cities, working in cities, they needed homes, so they pay a small amount of money as a principal, and commercial banks then issue mortgages to help them to buy a home. And this money will flow into construction companies, land auctions, steel, cement, furniture, home appliance. So real estate become China's largest credit channel. So mortgages create a new Chinese yuan reflecting the scale of Chinese true liquidity. However, this system only works in a society with a very strong repayment discipline, and China is really unique here. The Chinese people are among the most reliable borrowers in the world. Here's the number that China's outstanding external debt is about 2.42 trillion US dollar, and the external debt to GDP ratio is only 12%, well below internationally recognized risk threshold. Mortgages are rarely defaulted. It's very common to say that Chinese people has a 20-year, 30-year mortgage, and all their lifetime goal is to have their own property, which can be hardly imagined by people not living in Asia. And plus, that China does not have a personal bankruptcy policy. Everyone has to pay the debt, no matter what. This allows the bank to safely expand credit. Yeah, because of the hardworking Chinese people, the RMB is trustworthy. This reliability is the foundation of China's monetary system. The US system is different. Money is still debt, but here the government carries most of it. When the US want to spend, whether to support business or give money to people, it will issue treasury bonds. It is a long-term government debt issued by the US government to raise money. Later, we just call this government debt. Yeah. So first, these government debts are sold to the market. Big banks like JP Morgan, Citi, HSBC, international investors, pension fund, mutual fund, and foreign central banks. For example, China holds over 3 trillion US dollar in its reserve. The money earned by the Chinese manufacturing, and the proportion of it will be reinvested back to US government debt. The point is that the US has the ability to make the market to buy its debt. As long as the US doesn't default, the money issuing process will work. Around 22% of the money will go to social security, 15% go to healthcare, 16% is interest on national debt, and 13% go to national defense, and the remaining go to other programs. This system works brilliantly for the US, but for the rest of the world, it is not that fair. Over past 45 years, get what is the annual growth compound rate of the US dollar supply? Yeah, it is around 8%. This is a formula. So imagine other countries trying hard to up. Their GDP might grow 4% per year, which is already very good, but the dollar supply grows by 8% per year. It is like everyone is running on a running machine that they can never outrun. The harder they try, the further behind they fall. But of course, this system works because the Federal Reserve is relatively an independent bank. It does not simply promise to buy the government debt, and this debt will first go to the market, except in extreme cases. For example, during the pandemic 2020, the US Federal Reserve directly purchased about $3 trillion of the government debt, what we call the quantitative easing QE. Procedure is to directly add a number to the bank account. It is very much like printing money, but technically the money is still backed by the government promise to pay back. The U.S. government then distributes the money to its people. I thought with unemployment supplements, loan forgiveness, these are the money that people could spend freely. This direct injection, however, contributed to a serious inflation in the year 2021 and 2022, with the CPI reaching around 9%. From an economic view, this kind of direct government monetization would have caused the dollar to collapse. But the US Federal Reserve raises the interest rates sharply, attracting capital back to the US. Other currencies like the euro, yen, bond, Korean won, Turkish Lira, they all depreciate significantly against the dollar. Luckily, the Chinese yuan remained quite stable, moving around about 6.45 to 6.73 per dollar between the year 2021 and 2022. The main difference is that the US is the debt carried by the US government. The Chinese yuan is the debt carried by massive Chinese people. So the US system extremely advantageous for the US itself, but not very fair for the rest of the world. So here will come the very natural next question. Can other countries do the same as US? The answer is usually no, they can't. So let's continue with an important point. Not all central banks are like US Federal Reserve, and not all the governments are like the US government. The US Federal Reserve is actually relatively independent from the government, and it will take the inflation seriously. US Federal Reserve is one of the very few central banks in the world that target the inflation level around 2%, which means that it does not usually use the way I said directly add a number to the bank account to buy the government debt. Still quite disciplined. The US government debts are highly attractive to the markets around the world since the fact that US controls roughly 800 overseas military ports and supports international trade. Other countries, however, usually are not that fortunate. If other countries try to replicate the US model of government issuing debts to the market and then let the central bank stand behind, the outcome will be very different. The model only works when two strict conditions are met. The first is that the government must be trusted internationally not to default. And the second is that the central bank must be genuinely independent. These are the prerequisites for the US money issuance system. If a country does not satisfy the two conditions, then the Chinese model, where the money is backed by the productivity of households, is actually more trustworthy. Believing in people is often safer than believing in a single government, unless you are a US government. Because governments can default, it is a binary, it's 0 or 1 event. And history after the World War II give us plenty of examples. After like Argentina, Russia, Greece, Mexico, Ukraine, many countries has. As a financial advisor, I really rely on political promise. I rely on numbers. The probability of default of a national household is a statistic distribution. It's not binary, and over the long run, it is far less risky than trusting the single government. We take Turkey as an example, a case of a very unique economic policy environment. To conclude, in one sentence, that compared with the US, the Central Bank of Turkey is not as independent as the US Federal Reserve. When the Turkish government spending exists the tax revenue, the government will issue government debts to finance the deficit. It is exactly what the US government is doing. But the market demand for the Turkish government debt is often limited, so the central bank often have to support the government by purchasing some government debts. The central bank steps in so easily with no independence, as it listens to the president. This will effectively increase the money supply temporarily to support the economy, but it will definitely increase inflation. It does not mean hyperinflation, but in times of high inflation, conventional economic theory would suggest to raise the interest rate to control the price. But the Turkish policy chooses a very different way. It reduces the interest rate. For instance, the president has expressed his concerns that high interest rate would dampen economic activity, so the interest rate should be reduced. But lower interest rate can lead to large capital outflows, causing fluctuations in lira, and prices pressure for importation is huge. But luckily that Turkey has significant economic resilience. Manufacturing, textile, tourism, and automobile supply chain are very good. It still holds a substantial amount of US dollar reserve. These advantages allow the government debts to attract some market investors without the central bank to fully back them up. So there is no systematic collapse of a currency. But Argentina is a completely different story. In recent years, Argentina's annual inflation skyrocketed to around 200%, with price rising almost daily. The peso depreciated dramatically from a few hundred per US dollar to 1,400 per US dollar. The imported goods, energy, and and food costs immediately doubled. The government debts were almost entirely unwanted by the market because there were multiple past defaults. The international investor will think it is extremely risky. With no market buyers, the central bank have no choice but to step in. The central bank is almost entirely under physical control, directly printing money, buying the government debts, and even transfer funds to the government wallet. So this is no longer traditional quantitative easing. It is printing exactly the amount needed to cover the physical deficit. Argentina also lacks very strong industrial exports and have very limited foreign reserves. Without this support, the newly issued money will quickly become worthless. This is a result of a fully collapsed currency system. So this case is of huge implications. If currency collapse, the Nobel Prize winner Friedrich August von Hayek, so what will happen to a country when its currency collapse? The collapse of the currency is far more than a numeric devaluation. It is the silent disintegration of the social order. It begins with the evaporation of wealth. Life savings turn to worthless paper, and the purchasing power of a paycheck evaporates within hours of being deposited. It will be followed by a frenzy of survival instinct. Supermarket shelves are stripped bare, and people lose faith in nominal value, desperately chasing after physical goods. Society fractures into two classes, a privileged minority holding foreign currencies, and the vast majority struggling for daily bread. Trust disintegrates completely, and people lose faith in currency. In contrast, and in tomorrow, the collapse leads to absolute despair. The most severe consequence is that the best young people move away. This leaves their society with no choice but to relearn bartering because their money is worthless. So to ensure the stability of the currency is the most important duty of any government. Yeah. So let's in the end take a very quick at Europe. The two animations manifest the situation easily. The first one is the EU zone, Eurozone. Countries like Germany, France, Italy, and Spain, they all share euro, which means that they can issue their government debts, but they do not have their own national central bank to buy them. The right is with the ECB. ECB rarely steps in. These countries have to seek external buyers, which is the only way, or to cut spending or raising tax. It is really like Turkey. They are like the sharing the family wallet, but the key is someone else. In countries outside the EU zone, like the UK, Switzerland, yes, they can issue their own debt, and they still have a central bank as their final backup. But their economy are not that strong in manufacturing. They rely mostly on service. As a result, a lot of the new money will end up in stock market or real estate. Here, the real estate means the construction. The Chinese real estate, the construction of the real estate. Just buying a second-hand real estate doesn't create money. So the UK way or Switzerland's way will creating bubbles instead of boosting the real economy. From the year 2021 or 2022, while many global currencies fluctuated significantly against the dollar, but the Chinese yuan remained quite stable. This stability is rooted in Chinese unique monetary system, the domestic credit expansion. The currency is backed up by its people. Extremely low default rate. So with a stable currency and strong economic basics, the Chinese asset that quietly become a safe choice for many global investors. So if you want to spread your investments around the world and pick the stable assets, you may take a look at the Chinese companies that listed in Hong Kong market or backed up by the Chinese stable currency or get support from Chinese steady economy. So thank you for watching. In the next video, I probably will talk about Chinese semiconductor companies or AI supply chain. I won't just focus on the technology. I will explain the economics and how things really work behind the scenes. See you soon.